This is your daily real estate syndication show. I'm your host, Whitney Sewell. I want to dive into a topic today that I hope that you are familiar with. And I was speaking at a conference this past Saturday, actually, to a group of investors in Orlando. And a majority of their questions were about this topic because of a number of them being involved in this over the last week to 2 weeks, many of them actually, unfortunately. The topic is capital calls, and it is definitely a term that we try to stay away from and pray it never happens to us, right? Thank the Lord, LifeBridge has never had a capital call, and I pray we never do. But unfortunately, there are many in our industry who have, and many investors, many of you who are potentially in the middle of this at the moment, or you've received a capital call from an operator. And I want to dive into a number of things today that I hope you're aware of or are learning, as you evaluate this, and even what your responsibilities are, and just some ways for you to be proactive as well. So, I just feel like it's fundamental for about any real estate investor, right? And it occurs when the manager, or the operator, in our case, of the investment, they need funds, right? And this can stem from many situations. It could be just unforeseen expenses, or just the scope of the project changes, right? Or financial issues due to changing market conditions. But recently, many investors, right, have encountered capital calls, and it can be from obviously floating rate debt, which is one of the biggest causes, I believe, at the moment. And floating rate debt, type of debt that comes, obviously it's variable interest rates, right? That they may initially be lower and offer, say, some cost savings. However, the rates can be tied to market performance, so meaning they can fluctuate and increase based on just the economic conditions, right? As we're experiencing at the moment. But a big piece of this too is the expiring rate caps, right? And so these caps, they're safeguards, right, that prevent interest rates from going too high, right? Or exceeding a specific limit. Like you buy the rate cap because that's as high as it can go. That's why it's so important to have those and to know when they expire, no doubt. But when they do expire, and without renewal, right, it can just significantly change interest rates, and obviously affect the payment of the deal, and make it so high that the deal can't perform. It can't provide cash flow, obviously, at that time, but even worse, can't pay its own payments. And so that's why it's so important that when those are going to expire, and that you have a plan, right? And this type of debt's been used for many years now, and in many ways that it's been useful to have that type of debt, but it's also counting on that interest rates aren't going to rise, to a place like they have today. So, capital calls, though, are not merely requests just for more money. It can be obviously indicators of the health of the deal and in its future needs, but we want to ask some questions. We're going to get to a few other things, but why are more funds needed, right? And it can obviously range from covering the cost from overruns, or funding additional project phases, and managing unexpected heights and interest rates, like I've been talking about. But we want to know what the impact is, right, on the investment. So additional funds might be needed to stabilize the project, or do a number of ongoing things for the deal. But a capital call can affect the timeline and return on investment, the overall success in many ways. We're going to jump into some of those now. So it's just essential that you know how to navigate some of this, right? So we want to review this capital call, this notice that you have received, and we start. I want to have a very thorough understanding, right? And what are they asking for? What are they requesting? So look into why are additional funds necessary? So now, obviously, floating rate debt, right? Like I talked about, and that's the impacts of that. The expiration of the cap rates. Obviously, that's why many capital calls are happening right now, because they want to be able to fund that rate cap, or to get into the next cap on the rate, which is needed. And so, many deals right now that were purchased over the last year or two, that rate cap may have cost $25,000 to $50,000, which is pretty inexpensive when you're buying a deal that's, $20-30 million project. However, now with interest rates where they're at, that same, this rate cap on the same project, it could be $1 million, right? I've heard this happen from many operators, and now the deal obviously wasn't expecting that. They weren't planning for that. So now they have to have capital, right, to be able to do that. And so it increases this obligation for investors in a massive way, if the deal can't fund that. So you need to assess the urgency, right, and the legitimacy. You got to determine the immediate need for these funds and whether the request is a result of unexpected market conditions, right, or potential mismanagement. Big difference. You need to know, right? You want to scrutinize the financial health of the project and how these funds are to be used to ensure alignment with the just the original investment strategy. Is this still aligned with that strategy that you signed up for? Right? Is it? And you want to evaluate that, right? And so even evaluate the personal financial impact that it's going to have, right? Reflect on your own financial situation before committing further capital, right? And you got to think about that for sure. Having your own house in order before you're sending more funds out to fund this deal, this project that's needing more capital. And so, consider those potential benefits, right, of the additional investment, such as preserving and potentially enhancing the value of your initial investment, and the risks, right, such as extending more resources into, a project that may not return anything, which would be the worst case scenario, for most limited partners or passive investors. So, obviously the communication at this time is crucial, right, between you and the operator, communicating with that management team, the asset management team. We just need very open lines of communication, right, with that operator. It's just crucial. And we want to discuss these concerns and just the financial analysis, just forecasting and what's going to happen and what's our plan moving forward. Most of the operators during this time are going to be doing webinars. They're going to be trying to inform you, right, and letting you know why they are having a capital call, and they're going to try to lay that out there. But hopefully, there's a time for question and answer at one time or another, or ways for you to follow up to get your questions answered. So, let's think about also the legal ramifications, right? Or, we want to look at those documents closely. Hopefully, you looked at those when you were doing your due diligence to invest in the deal. Oftentimes, people do not, right? It's unfortunate. More times than not, they have not done that. But we want to look at those documents and see exactly what they say should happen or what's going to happen with your capital. And one thing to keep in mind is the order of the capital stack, right? If you do invest, there could be ramifications for the capital stack. And if you don't invest, there could be even bigger negative ramifications, one way or the other, of where you're placed in the capital stack. Meaning, where you stand, with your capital, and who's going to get capital back first, when the deal does pay out, given that this plan works, right? That the operator is presenting, to you. So, we also, you want an attorney to look over these legal documents, right? Hopefully you have a personal attorney who can, review these documents and ensure, that what you're looking at especially before you put more capital in. You may have invested $100,000 and now they need, 10, 15, 25,000 more from you individually. And you want to know, like, what happens to your investment, right? If you do that. And also if you do not do it, just remember it could change it altogether. Where you sit in that capital stack. So I encourage you to be, proactive, right? And it's key in managing your capital, in any way. So, first off, personally, I want you to have a reserve fund. It's just, it seems like common sense, but most people don't do it. And oftentimes we're investing capital out in funds and in deals because we're excited about them and we want to put the money out there, but we have not made our own reserve budget over here, right? And we want to make sure that, hey, our family's going to get to eat. We lose all this capital that we've invested over here, we can still take care of our family, right? So please have an emergency fund, and even as you make money off these deals, off these passive investments, taking a portion of that and putting it over here would be a good idea, right? Just that financial buffer that could be so crucial when life happens, right? The other thing, conducting thorough due diligence, right? So before investing, understanding all aspects of the project includes analyzing the risks associated with the properties, whether it's the location, the market dynamics, the sponsor's financial health is something that I don't see considered or asked about too often. The history, of their performance, right? The previous performance of the operator. And just knowing the strengths and risks, right, that you anticipate through this potential project. Hopefully that's being talked about through webinars and documentation, all those things. But you want to ask about those things. Also diversifying your investment. Here's something that we talk about often. Spreading your investment across different asset classes or obviously markets, geographical locations. But right now, because of what's happening, we need to be thinking about, hey, how are you diversified even across the types of debt that's on the types of properties that you're investing in? If you think personally as an LP, look across your investment portfolio and how many deals have you invested in that have floating rate, a bridge debt, right? Or just floating rate, no cap, or how long, when's those caps expire, right? On all those deals. Do you know that? If not, you should be asking when those expire and the types of debt and thinking through, hey, if you got 5 different deals that you're investing in, are they all floating rate debt? Or is one of them, and did you know that going into it? And you may not have thought about being diversified in that way early on, but many people are learning that the hard way right now. So just having a mix of debt structures, right? Hopefully more long-term fixed rate debt than anything would be suggested. But obviously against market fluctuations, economy, things like that, there's being diversified across operators, asset classes, even the types of debt. It's just going to help you to hedge against some more risk, right? Maintaining open communication, which we've talked about a little bit. We want to be transparent with our investors, and we want them to see all the information that they want or need about their investment. We hope that we work a lot on providing a ton of detail around the investment opportunities or how the deals are performing, right, for our investors. And we've put a ton of time in that. So many team members that are involved in the updates that we send out on a monthly basis to investors. So I encourage you to educate yourself, right, on the market, on financial strategies, and just being informed on financial trends and market shifts that impact you, right, and impact your investments. And just understanding those indicators, right, whether it's interest rate changes or something that could send us into a downturn, right? Just want you to be prepared and thinking through, what direction your investment portfolio as an LP is going in. So let's think through these capital calls again here, right? We want to understand, why is this capital call happening? Why did it happen? What did the operator do or not do? Is it because of a lack of performance? Is it something unexpected? We want to remember just to ask those questions when we get that email or that phone call from the operator. What caused this, right? Because what's going to happen is that's going to inform me as the LP. Do I believe they can still operate this deal? Is the plan, do I believe it can happen? Right, before I put more of my hard-earned money in the deal, because there's definitely times I would, right, continue to fund the deal, and I just stress too, there are things that can happen, for your operator that are completely unexpected. It is a large pieces of real estate. Things happen, right, that are unexpected. We do have massive reserve budgets. We do plan for many things, right? We hope we catch, as much as possible during our due diligence when buying the property, so we know what to plan for, whatnot. But there are things that can happen. And so I encourage you to ask questions from your operator, right? Don't just immediately assume that they've messed up. Don't just immediately assume that they have done something wrong or not performed like they should have. Let me tell you, they are hating it as much as anybody, and oftentimes are going to have capital invested in the deal also. And I hope that they do anyway, or hope that you made sure that they did if you invested with them. But I just encourage you to ask questions and to figure out, hey, what caused this, right? Was it negligence, or was it just something that they couldn't help? And is the plan that they have a good one? Do I believe that they can pull this off? Or if there's something that caused this, what's going to change that moving forward? I want to know that before moving forward to put more money into this deal. Because remember, there could be a time that you do want to put more money in. They could be asking for a very small piece of money, right, across all they could have so many investors in the deal or fund that they required a very small amount from you. And so it could be very well worth it, right? But remember, you want to review what happens to the money, to your capital. Where do you move in the capital stack based on, if you do invest more or if you don't, right? You want to know what happens to the capital stack because it could negatively affect you a lot more by not putting more capital in. Depending on if the deal did well, right? If the deal continues to go down, then obviously you're going to hope you didn't put more money in. But I just want you to go in eyes wide open, knowing that, you want to ask questions, figure out why it happened. Can this plan make it work? Is it worth, more of my money going in? Be proactive, right? Have your own reserve budget and ensure it's full before you're putting more money into a deal, right? As well, if this deal is in this kind of trouble, it's probably not going to be paying out capital or cash flow anytime in the near future, right? So if you're depending on cash flow, then maybe you need to think about not putting money in, right? But you do want to know why that's happening or what happens to your capital. Like I said, I just cannot stress it enough. Obviously, I've said it numerous times, but I hope that you're not in this situation. But it is a topic that's talked about a lot right now, and investors just need to know, hey, go in eyes wide open, ask questions, know what happened. Is the plan good? Can I afford to put more money in? And do I really believe if it's going to work or not? Remember, I am not an attorney or a CPA. I hope that you have legal counsel and tax help so you can understand the benefits, of this or not for your own personal portfolio. I hope that you have a blessed day. I look forward to seeing you again, listening to the Real Estate Syndication Show.